Good afternoon, everyone. Hi, my name is Steven Snyder. I am one of the co-organizers of this event. I'm very happy that you could take the time out of your weekend to be here with us. This is the second of our series of these conferences focusing on sustainability and finance. And I'm very happy that we are able to do this again in partnership with Harvard's Environmental Club, with Oikos International, which is a student group that organizes events and such like this, and also our Twitter partner, SRI Events, who's online right now promoting and conversing with people on Twitter regarding our conversation here. A little housekeeping is that after our presenters share their presentations, we will have Q&A, and that will be done through a platform that I will share in the chat. This platform will allow you to upvote questions that you want answered, so please go ahead and do that. I am going to start a poll so that we can figure out where everybody is in the world and what their level of engagement with this topic is. The host won't get to see it, but participants, please go ahead and answer that poll now. I've shared it with you. In the meantime, I want to introduce our moderator. Sangeeta is a real dear friend of mine, and I'm very happy that she was willing to come and talk to us today and moderate this session because she really is passionate about this topic. She used to be a debt capital markets lawyer and is currently working for the City of London, helping out with COP26. And she also works as a marketing consultant on sustainable and green finance. So Sangeeta, thank you so much for participating in this. Before I hand it to you, I will, in the poll right now, about half of you have answered it. And you can see that majority are coming in from Western Europe. That's great. But there are a lot of people here from the United States. We have a majority of people who are undergrads. So that's great. Thank you so much for being here. And people have heard a little bit about Oikos. So I'm really interested and happy that there are other oikis on the call here participating and learning from you all. So Sangeeta, please take it away.
Okay, thank you, Stephen, and hello everyone. And welcome to today's seminar, which is entitled The Language of Sustainability. And I'm delighted to chair this panel, so thank you, Stephen, for asking me. We have an incredible lineup of speakers, and I'd like to thank them before we kick off for sharing their expertise and thoughts with us and giving up their time, so thank you all. So this panel is going to focus on language and really looking here at the language that we use in sustainability, because this has a real impact on the actual end goals that we're all after. And we find in practice that this language somewhat differs from the perspective of the project owners and the financiers. So I think it's really important that we forge an understanding of the issues that are involved here so that we can all achieve a common goal. So with that in mind, I would like to introduce you to our first panelist, Tammy Tullis. Tammy is based in Florida, where she is the president of Moderator LLC, which enables financing for large-scale green projects. She's also director at the Center for Infrastructure and Society, the CIS. She's got more than 24 years experience in the global capital markets, and which she's brought into the environmental space. So we're really excited to have you here, Tammy. And I'm going to sort of hand over to you. Thank you.
Okay, good morning. So happy to speak to you all. This is a very interesting topic that's been mulling around in my head in terms of how to resolve issues. Well, let me just go into, if we talk about the large types of finance that people consider, you have private equity, venture capital, you have equities, bonds, you have development bank, philanthropy, and governments on the top scale. And then at the bottom, you have the projects who are trying to get there. There's a general acceptance that investors around the world now are after green project products or SRI products because their investors want it. Who's their clients? Their clients actually the police, teacher, and firemen. All those common people put their money into pension plans and now demanding it. And that's why the asset managers want to go down this route. However, how do they do this? And this is where the source of confusion comes in, because there is actually no commonly accepted standard. For example, when we talk about credit risk, we use rating agencies, and the largest three in the world are Moody's, S&P, and Fitch. And those are commonly accepted standards that the investment world uses. In environmental cases, definitely not this case, and not so much in the ESG either. I'm sure Wayne later can talk to us a little bit more about that. And in the ESG side, there's been greater strides made, but not in the specifically green space. And talk about, and where I see this, when you look at an investor process, what I see happening, like indeed how I have, when I worked in for a large global bank last year, how I put it into my investment process as I looked around the world in emerging market investments, we still have the due diligence that we need to do for every single regular investment, right? So that means looking at the macro development issues. What are the regulatory issues? Who are the competitors? And then we need to look at the micro as well in terms of who are the managers of this project? What is the profitability? What is the cash flow? Issues like that can be very hard for an environmental project to answer. Generally speaking, those type of projects are new, so they don't have the history, and they can't get that kind of data. That's something which I find I've noticed very much. I wanted to talk quickly about green bonds. I am a bond girl. I love bonds. The power of bonds to raise money, and there is so much money out there for green bonds. What is the difference between green bond and regular bond? Nothing, except for the green bonds provides the money for ESG green type of projects, right? Think about it though, those projects, monies will have to go into projects which are validated though. So once again, you have the issue of connecting with the correct projects. Financing, the money is there. I want, very quickly, one of my own personal goals is to do a Florida resilience bond, because Miami is frontline to climate sea rises, one inch every 3 years. Obviously, I want to save my house, self-interest. Raising a couple $2 billion from the Florida treasurer is not a big deal, right? Because Florida has a great credit rating. I have friends who are investors in some of the largest fund managers in the world. They would love to buy this. Do you know what the problem is? The problem is that we can't find scalable, large enough projects to invest in. I could go on for this for another 20 minutes. I won't. I'm just going to say that's the kind of problem that we have. And so we have a situation in terms of large scale finance when there aren't that many projects that can be purchased in any of these asset classes, right? Because you've got to be large enough to be able to jump over the investor's due diligence process. When I've worked with smaller companies, the issue is on the reverse. So they all really, there's tons of them around. They really want to get that large scale finance, right? But they don't have the skill base. They don't have the history. And I know that James will talk more about that later. So I'm gonna let off there and chime in when necessary afterwards.
Thank you, Tammy. That was really interesting, and I think as you were saying, sort of picked up on the point about the fact that there is a lot of funding available, but actually some of the projects are very small, and it's a question of scaling up or aggregating these projects in order to actually match the funds. So I think this is a good moment to then pass across to James, and as you said, hopefully you'll be able to maybe chip in later on in the conversation or when we have questions at the end. So James Ellsmoor originates from the UK. He's a digital nomad and has lived and worked in over 60 countries. He's a founder of Island Innovation, which is a global sustainability company which connects island communities to advance cooperation and collaboration. And last year, Island Innovation hosted the first virtual Island Summit, where 4,000 plus island stakeholders from around the world participated in the first entirely online event of its kind. I was delighted to participate in this last year, and looking forward to this year's summit, which is going to be held in September. James also started Solar Head of State, an NGO working with governments of small island developing states to promote renewable energy. I think he did all of this whilst he was under 30. So bravo, James, super impressive. So I'd like to hand over to James, and I'm sure he's going to share some really interesting insights from being on the kind of front line of the kind of projects that we're talking about. Thank you.
Well, thank you, Sangeeta, for that lovely introduction, and for Tammy for the interesting presentation. And well, both Sangeeta and Stephen for all the support they've given to the Virtual Island Summit and everything. I think it's really interesting that we're discussing finance issues through a perspective of language. I don't have a particular strong finance background as the other panelists, but obviously the finance angle comes in across all projects. And so I wanted to talk a little bit about the differences between different sectors. So Island Innovation, we make a point of collaborating with the private sector, the public sector, NGOs, academia, and I throw in utilities as an extra one because utilities often kind of bridge those different gaps, and I do a lot of energy work, so clearly utilities are an important part. And in the countries we're working in, so for example in the Caribbean, most projects require at some level the involvement of all of those different groups. It may be sometimes at universities less or more. Obviously it depends from project to project, but often all of those groups need to be involved on some level. And particularly actually the NGO and development partner perspective is often more important in smaller countries where they play a big role. And it's important to emphasize that because I do notice how different the language is, how you can say the same thing, but different groups or sections of industries will use different language around this. And so often that can lead to kind of miscommunication or a lack of interaction between different groups. And so we really try and make an effort understanding the perspectives of these different sectors and trying to bring them together to collaborate and cooperate. So I think Tammy made a good point. What's the difference between a green bond and a regular bond? Well, it's a language question. There's obviously some, and that does have implications, but really it's just how you are referring to them, and that really changes how people relate to a certain principle. A green bond, I know Tammy probably wasn't referring it to this, but calling it a green bond, as well as the other implications that has, is a fantastic marketing tool to encourage people to be involved and feel like they're doing something good and involve all of these different perspectives. So as a communications tool, it's also really important to think about how you refer to these different areas. And on that, there have been some really good initiatives from some island communities. Think about the Seychelles Blue Bond, Fiji's Green Bond, how they are using these type of financial tools as a way of raising money that they can then invest in protecting their national environments. So from the islands perspective a little bit, islands are really at the forefront of a lot of these climate environment issues. Island communities see the impacts of climate change first. That's because increased sea level rise, increased risk of natural disasters, but also the economic effects. And actually what's happening right now with COVID-19 is a really good illustration of that. Unfortunately, the small economies are very, very vulnerable. If you depend 80% on tourism for your economy, then clearly you're in a very difficult position right now. And that affects some islands more than others. In the Caribbean, Aruba is particularly affected, but obviously large islands like Jamaica are also affected, although their economies are a little bit more diverse. Resiliency is a term that is often used. And so while we're discussing language, I wanted to dive into the issue of resiliency a little bit, because it's a term that gets thrown around a lot. And particularly in this financing sector. Resiliency, I'll just read you the definition I have written down here. The ability of groups or communities to cope with external stresses and disturbances as a result of social, political, and environmental change. So essentially, your core group, how do they react and respond and adapt to change that is not necessarily coming from them, that is impacted from outside. So clearly again, COVID-19 is a good example of communities needing resiliency, thinking about that on multiple levels: social, political, economic, environmental. And the reason I want to focus on resiliency, so as far back as 2013, Time magazine highlighted resilience as the environmental buzzword of the year. And it's still a buzzword, but I do think it's a useful concept, but it gets thrown around a lot, often with people not necessarily having a particular definition or knowing particularly what it means. Many of the leading institutions, from the World Bank to the UN to local and national governments, they take up resilience as their core célèbre and a fundamental mantra to their work, without always defining what it means. And that's important because it can mean something to different people. Like most of us in this conversation would probably agree that resiliency is an important term to consider. How can communities adapt and change? But it's also important to think other people have refuted the term, and other people who are on the grassroots side, particularly, and the last conversation referred a lot to Indigenous communities, particularly in Indigenous communities, and also in island communities. They would argue that the language around resiliency actually puts the onus on the people being impacted as opposed to the people creating it. So in some terms, in some communities, resiliency is actually looked upon as a bit of a dirty word, which is interesting because in the circles that I'm in, mostly resiliency is seen as kind of our goal to go to. And these are kind of different perspectives on the same term. So just to explore that a little bit more, the reason that it's often been refuted is the idea that the local community needing to adapt and needing to change to something that they can't control. By using the term resiliency, people might say that actually puts the emphasis on the islanders or Indigenous communities to be resilient, without actually saying that the people creating these changes and causing the problems, i.e. the people emitting carbon dioxide into the atmosphere, should take action. So I think that's an interesting case study just to consider. I'm conscious of time, but something else, I'm just looking at the notes I have written of a few different things to cover when thinking about financing for small island developing states or small countries in general, is project size. So often the financial incentives are less to go into smaller countries. On the one hand, if you're thinking about investing, again as an example, in renewable energy in the Caribbean, the numbers at first might look good as an investment, because in the Caribbean, the cost of renewables can be anywhere from 3 to 6 times higher. The cost of electricity, rather, is 3 to 6 times higher than the cost of electricity in the US. So it's a good argument to invest in renewables. But then if you're looking at a country that might have 50, 100, 200,000 people, the size and scale of your project is not necessarily there. And so one issue I've seen and the Green Climate Fund is a good example of a fund that was instituted by the COPs, by the UNFCCC process, the international climate negotiations. The Green Climate Fund was money that was designated to help people or help communities and countries adapt to the impacts of climate change. The issue is that the scale of some of these funds is so big that it's requiring projects that are at the minimum tens of millions, if not hundreds of millions in size. If you're in a country, Tuvalu is a United Nations member state, a Pacific Island country, the entire population of the country is 12,000. So do you have the scale that you need in some of these smaller countries to be able to apply for that? And also, do you have the capacity? This is a really important issue for small countries. Do you have the capacity to be able to do all of the bureaucracy that is needed to access these funds? Because often these funds are going to come from government type or quasi-government organizations as well. But if they need to be controlled, obviously, to make sure that money is being used well. But if it requires a year's worth of paperwork and you only have a small team, do you have the resources to take that gamble of doing that? So there's a lot of different issues to go into that. I'm conscious of time, but feel free to drop any questions in the chat, and I know we'll have a bit of a discussion afterwards, and particularly if there's any other perspectives of how these different types, public, private, government, NGO, universities, etc., can interact. We'd be happy to discuss that in the discussion afterwards. So back to you, Sangeeta.
Thank you, James. That was really fascinating. And as James mentioned, if you want to ask a question, we've got some questions coming in already. So if you send them in the link that was posted earlier, if you post those questions there, that'll be really helpful. And then we'll start asking questions after our final speaker. So I think as James and Tammy have both discussed, we've looked at the perspective of the financier, and we've also looked at the projects. And I think the issue sometimes is that a lot of these projects are very emotive. We all know they're there for our greater good. We all want these projects to happen. However, when you're looking at it from a strictly banking financial perspective, they might not make complete sense when you're looking at the normal risk assessment criteria. So that brings us nicely to the importance in all of this to independent ESG research and ratings. We need this kind of information in order for investors to make informed decisions. And so we're delighted to have Wayne Seaton with us today. Thank you so much, Wayne, for joining us. Wayne is the director at Sustainalytics in New York. He has a very long and illustrious career in investment banking, and it's great to have you on the panel. Wayne is responsible for strategic growth in the global fixed income market, specifically for sovereign, sub-sovereign, and corporate asset classes. And in his role, he integrates ESG, so environmental, social, and governance metrics and methodologies to help both issuers and investors. So Wayne, I'm going to hand over to you. And as we said, keep the questions coming, everyone, and then we'll come back to you after Wayne's little session now. Thank you.
Great, thank you very much, and very thrilled to be part of this illustrious panel. I do have some slides, so hopefully those are in full view. And with that assumption, I'll go through the implication of this very convoluted topic, which is language, and how do you get some systematic applicability of the language of sustainability to what I do, which is ESG and fixed income. So that's the goal for a few minutes. And what I'll do first is talk a bit about the company that I work for, which is Sustainalytics, and what we do. Sorry to
interrupt, Wayne.
Pardon?
We're not seeing your screen. You'll share the screen at the bottom.
Okay, all right. That's I thought you were going to do that, but I'll easily do that for you. So let's go through that exercise and share my screen and share. Okay. Unfortunately, it's going to take a little while because my privacy settings are actually not activated for that. So why not just go ahead and just walk through rather than delay the proceedings here, because I think that would be the best way to, in the essence of time, continue with what we have. Okay, right, good. I see something pop up. Is that you? You're sharing it, right, Stephen?
Yes, I am. Just give me 1 second. I'm gonna open it as a PDF.
Sure, thank you.
No problem. Okay, that should be sharing now.
Beautiful.
Awesome.
All right, so on the very next slide, Stephen, we'll just kind of go through. Excellent. So just to start off, Sustainalytics is a pure play investment research and ratings firm. So what does that mean? Well, we provide very systematic ways of measuring ESG, and we take a lot of data to do that. The data, when I say a lot of it, is really why I said that the language is a very convoluted exercise to translate that into very simplistic ways of measuring risk. We do have 17 locations. We're global. We also have several use cases of our data. which I've highlighted on the right. So someone could take a look at our data for active investing in stocks, for instance. Someone could say, I don't like companies that are not, or countries that are not in the ESG business and are doing bad things, or having human slavery, or not protecting the environment. We measure impact. So we have thematic investments. We talk about product involvement. We talk about a company or a fixed income entity that is thematically aligned with ESG measures and being good corporate citizens across the board. We also have clients that use our data, quantitative investment managers, so asset managers across the globe that actually invest in securities, both equity and fixed income. Tammy did mention that she's a bond girl. I have not yet been called 007, but in my career, I am a bond guy. And so my role at Sustainalytics is to head the fixed income investment management products. And so we design and create ways of, again, channeling all this convoluted data into very systematic ways of measuring ESG risk for both the investors in ESG vehicles and also the issuers of debt. James, you did mention that they're green bonds. That's one of the vehicles that we'll talk about a bit, that investors actually need to understand the language to determine if they're truly green or not being green. So those are some of the use cases. And if we can go to the next slide, I'll talk a bit about the global fixed income markets. So again, very heterogeneous, lots of terminology and language is again challenging based on SASB and PRI and GRI and SRI and a whole bunch of things. But the fixed income market, again, focusing on debt, is very, very fragmented. I mean, there are lots of asset classes, and it's really hard for both investors and issuers to really gather all the different data points, that are being generated by ESG ratings providers and others to determine if it's going to be easy for them to integrate or to make a valid investment decision. Well, the World Bank basically dispels that myth. And so there's a caption they're taking directly from one of their most recent reports in 2018, which said that basically ESG integration should be part of any valid investment analysis and can actually assist investors and actually assist issuers to do projects, and in some cases to enable small projects to be scalable and to enable large projects to continue to access the market. Now, if you take a look to the left of this page, you'll see some of the considerations, which are unique to the fixed income markets compared to the equities market. First, it's larger. There's more debt issued than equity. It's 100 trillion basically outstanding. It's very diverse. I mean, you have asset-backed securities, you have treasuries, you have a whole bunch of different asset classes in different markets globally. And it's really hard, given the fact that fixed income, by definition, debt is a contract and measures the ability of a issuer of debt to repay debt over time. It's really hard to integrate a lot of these factors to say, well, gee, if there's a resiliency or a climate change issue that could go for 30 years, how is that going to be impacted in integrating this convoluted language into debt? So that's a fundamental difference between fixed income and equity, and there are a variety of asset classes. If you take a look to the right, there's a pie chart that shows the 100 trillion outstanding by geography. And so again, diversity in terms of asset classes and also in terms of geography. Again, it's a lot of convolution, lots of language, whether it's impact or sustainable or, product involvement or GRI or SRI. Most of this all funnels into how do we integrate ESG into fixed income securities, and the case is building and building and building. It's easy to think of equities where you have a company and it's one where the board is not diverse, or it's spilling oil into the oceans, or not doing good things in supply chain, and that's a company that has one stock. But again, as I mentioned in the previous slide, with fixed income, there are multiple asset classes. So there are steps that have been made to integrate ESG, integrate this language, and here are a few publications that talk about it. I'll focus on just one of them, which is the World Bank again, where it says, that evidence is there that says incorporating ESG into fixed income is an important part of risk analysis, and you shouldn't look at ESG, i.e. investing in doing good, should not be at the expense of investing to get a good return. So it's very important to take this as the context into what I do and why it's important. And if we move to the next slide, I'll focus on, again, some of the challenges of integrating ESG into fixed income and some of the nuances that I alluded to before. When you do a debt financing, you have many different types of ways you can finance it. The government of Jamaica could do a 5-year note. The state of Florida could do a 30-year bond. So there are different types of structures, all of which impact, as I said, the willingness and ability to repay that debt, but also the difficulty in integrating ESG factors into an investor's viewpoint as to whether that debt structure is creditworthy, and also an issuer realizing that they have a project to finance, and it may be that it could be that much more financeable if you integrate ESG factors into that debt structure. A second difference between equities and fixed income that I work on is how do you enable a investor to state the case to an issuer that it may make more sense for you to integrate certain steps in your ESG framework. And if you do that, or if that's systematic, then it could mean that there's more investor demand. That's called engagement. And then we talked about the complexity, especially in terms of the convolution of the language, the lack of transparency, sometimes for some of the smaller project financiers that may not be listed or may not be able to access the markets, and then the multiple level of bonds that are there. Again, I talked about 5-year or 10-year or 30-year. So a lot of times it's very complex. If you can go to the next slide, I'll talk briefly a bit about one of the products that I manage, and I'll just briefly state that this is a very good way of showing how the language of sustainability, which is from multiple sources, can be channeled into a very, very specific understanding of why ESG is important to project financing, and in this case to a risk of a country. So basically a lot of stuff on this page. You have indicators such as natural and produced capital on the left, human capital, institutional capital. So we're getting data from a country's use of its natural resources and its infrastructure, the rule of law, and we're putting that into a very, very specific communicative way of saying that that's national wealth. So national wealth is the way we communicate this language. Then we're also taking a bunch of factors and showing trends, ESG performance, ESG trends, and ESG performance, and putting them into a very specific management of wealth, which again is a way of saying that we can measure very, very clearly how a country manages its national wealth, and we put that into perspective of measuring risk to the country's long-term prosperity and its economic development. So the point here is we have 41 factors that we blend into one theme, which is how do countries measure their risk to long-term prosperity and economic development, and we assign scores. And so it's our way of saying that with this multi-layered approach, then there is a systematic way that investors and issuers can use to measure their ESG risk. If you move to the next slide, I'll talk a bit about one use case, which is just, again, on a high level. We published a blog post that shows how our country data that we showed on the first page for a specific country, Peru, how that is aligned to a mining company that operates in Peru. So there's applicability to say there's risk from a country's perspective in terms of how that country is actually managing ESG risk, but that risk is not isolated from a company that operates in that country. If we can go to the last slide really quickly. I think this will tie in a bit to some of the stuff that James was talking about. This is a peer group of countries in Africa. And what we show is that there is a correlation to the rating agencies, Moody's, S&P, and Fitch. In this case, we use Moody's, how they view a risk of a country's ability to pay its sovereign debt, and then how we show, based on all of the complicated factors that feed into our language, how we show ESG risk with a country. One might say that the two are different, but we believe, and the data shows that they are correlated. So there's a correlation coefficient of 0.83, which is pretty strong. We could broaden this, to, and again, looking at sovereign debt, to green bonds that are being issued in certain geographic jurisdictions outside of Africa. So again, it may not be out of the realm of possibility to focus on a basket of countries in the Caribbean or Latin America. So again, this is the language, this is how it's applied. And again, the theme is, there are a lot of data points, lots of sources, but we'd like to believe that we're addressing the challenge of integration of ESG data and addressing that in a way that's a systematic language.
Is it okay if I just want to address the audience before we go into Q&A? Is that good?
Yeah, go for it.
One thing which I want to talk about is green and greenwashing. How green is your green? I don't really care, honestly. That's my answer. The reason for this is because if we take some of the most pollutant industries in the world, so E&P, oil and gas kind of industry, right? They are one of the largest inputs into every country's, almost every inputs GDP, so to employ people, labor, technology, all of that. Clearly, this is industry, miners as well, who's been targeted by ESG, and as they should be, and I'm glad for that. Now, when these companies make a change into operating process, I think that is fabulous, all right? If these companies were not to exist tomorrow, that would cause calamity for globally. They need to evolve to something more sustainable, and that is what I support. Depending on which funds you look at, depending on which investor, some investors are much more purist than others. But in terms of larger investors, institutional investors in the world, they don't just look at the outright ESG, if you want, or the green of these issuers. You're looking at how far they've gotten, right? So let's say, for sake of argument, 10 is our absolute wonderful best, right? You have these oil and gas companies who might have started at a 2 or 1, or maybe we can say -5, whatever that be. If they manage to get themselves to a 3 or 4, that's a pretty damn big improvement. Even if the rest of the market, if you look at the universe as also all different sectors, let's say that all different sectors at a 5 or 6, right? And all these oil companies has gone from a negative to a +3 within 2 years or whatever. That's a really good thing. And we want to encourage this behavior. So that's what I'm going to say about it. The other thing is that, I work with projects as well as looking at on the higher level as an investor. And when you look at with projects, I'd like to get sort of creative about where that money can come from. With the ESG coming into large companies, those companies are now doing some direct investment. So for example, I'll give you, for example, the idea of mitigating some of their contingent liabilities, which are on their balance sheets, right? So that's something that chemical companies have, because they're always going to have, they have this waste that comes out that goes on their balance sheets forever as a contingent liability. There are laws which have been passed for a certain amount of technology which can remove that, which gives them their equity a pop, and that allows them to invest into, for example, technology which mitigates, let's say, the pollutants from cement, or lets them invest into a green project. So there are kind of weird kind of partnerships like that happening. Shell, we all know Shell, the oil company, for example, they bought into some forests, so growing trees. That doesn't necessarily dissolve them for any kind of bad that they've done, but this is working in the right direction. And also in Peru right now, I'm glad you brought Peru up. You know, there's Peru biggest GDP are the mines, right? Now there's $2 billion sitting there in the bank accounts of the Peruvian miners, which will go into mitigating or regenerative agriculture efforts on 20 mountains in Peru. So actually the source of funds for some of these, for some of the best green projects of the world could actually be coming from the polluters themselves. And with that, I'm finished. Thank you.
Thank you, Tammy. And I think you picked up on some of the chat, which was asking about greenwashing. So thank you for chipping in there. And thank you to all of you who've been sending in your questions. And I can see that we're coming up to kind of almost time for the session, but we're going to hopefully carry on until Stephen stops us. So there's been lots of questions. And I think one of the questions that sort of seems to keep coming up, and it really is just, James, if you could maybe just explain a little bit more about how do people find these projects? I mean, I think people seem very enthusiastic about getting involved, and just maybe a little bit about how you actually, in your experience, got involved with these various projects on the ground level. James, have we?
Yeah, I'm just thinking how to approach that question, but I think part of the issue is the disconnection between project developers, project financiers, and kind of everyone in between. There's not. I mean, there are different ways of approaching that and bringing people together, but often the issue is just trying to build those bridges and connect those different parties. And you know, I find it funny because I sometimes will get approached by people in the finance area saying, we've got these funds, we just can't find any projects to invest in. And then you have people who are trying to develop projects saying no one's willing to invest. And so I mean, I sometimes have tried to play that role of bringing people together, but it's easier said than done because there are reasons why they don't necessarily fit together. So a lot of it does rest on this communication issue, is my point. How do you actually try and build them together? And there have been efforts to create platforms. For example, IRENA, the International Renewable Energy Agency, I don't know what the status of it is now, but I know for a while they had invested in building a platform which was essentially designed to fulfill this purpose, to showcase potential projects, to showcase potential investors or the other parties that are needed to bring them together, including engineering firms, etc., and bringing those people together. But yet those platforms then don't necessarily get the traction that you'd expect. So obviously I don't have the answer here, but it's obviously more complicated than it seems, and would love to know other people's thoughts on what has been effective on bringing those people together, because it's a really kind of obvious disconnect that exists.
And I think it's a very big question. And I don't think it's one that we'll be able to sort of fully get to the bottom of today. Tammy, were you wanting to just add something?
Yeah, I was saying that I spend a lot of my time doing just that. So I spend a lot of my time actually talking to the projects on the ground of various different sizes. So whether they be pre-seed, post-seed, i.e. when you say post-seed, I kind of mean that they've already got their MVP test example up and running, right? And they try and prove for that to work. And then they're trying, so you got the projects which got the philanthropy money and now trying to get to the largest stage of having $50 million investments, $200 million investments. The biggest challenge is data and the cost of getting that data. The higher up you get in terms of the amount of money you're receiving, right, or you want to receive, more onerous is to the proof that you have to provide. So I see a lot of project owners who, by the way, are PhD in various sciences, and they've put so much of their life in this, all of a sudden have to reinvent the wheel themselves to understand what finance means and what investors want. And that to me is a great misuse of their time and their expertise. But that's what what they're going through. I have a fabulous project in Mexico, mangroves regenerative, and the guy is living on the shoestring, and it's really quite frustrating. And once again, it's the language difference, it's a data requirement difference, which the large investors need versus what the smaller projects are able to bring. And so that scalability doesn't happen, right? And so in my intro, I was talking a little bit about big project bias. And that's why, right? So all investors may be investing, let's say, in the, let's say, 5% of the projects available in the world, which might, those 5% of projects may, just off the top of my head, may represent the monies given out to, like 80% of money is given out to green projects, just because it's so difficult to scale from small philanthropy. It's hard to get that philanthropy money, but the first scale from philanthropy to the first round of, let's say, VC, PE and VC, you need to get, catch me next time if you want to know, there's too many nuances, to this VC, PE, bank loan type of level, right? To get the really big investments of the 200 millions, you have to have a certain maturity to get there.
And I think, as you said, thank you, Tammy. I think, as you said, there is so much we can say in this area. And one area which I don't think we're going to have time to go into, but is really bringing in the concept of the public sector and how, in order to scale up or in order to make investors feel happy, whether there has to be some kind of public sector financing or involvement. And I don't think that's for now, but it's just a thought which I think is obviously in the market. But another question, and we have got lots, and we may not get through all of them, but one of the things that has also been raised, and I think this is probably for you, Wayne, be good to get your thoughts on this. Isn't there a lack of empirical evidence that impact investment really leads to profit and positive impact? Have you got any famous examples where it's worked? And I think that's really what it gets down to, that if people are seeing that actually by doing this, they can actually make a profitable investment, then all of the issues and the concerns that we've been discussing will go away. So yeah, Wayne, do you have anything to add to that?
Yeah, I mean, there is a ongoing question, and you have to put it in perspective that in general, this is a relatively new attempt to put systematic measures using ESG and sustainability to investments. I mean, impact has been around for hundreds of years, but we've now tried to establish ways to measure it. There are impact funds, that are out there, but to me, impact is really setting a time zero and then measuring it. And if you think of much of the stuff that I've been talking about and sustainability, is not as if our time zero goes back to when capital markets or project financing started, 100 years ago. So one can say, yeah, there are examples. Some of these examples exist in Europe. Here in the United States, where I'm based, I can say that anecdotally, there have been extremely exponential increases in the number of deployable assets to responsible investing, of which impact investing is a component. And some of the larger examples exist within, like, private equity firms like Blackstone that just set up an impact fund. If you just take a look, you'll see that there is anecdotal evidence, because investors are realizing that, again, we're not at time zero right now, but the measurement is being more enabled, and funds want to have not only return, but a measurable impact on some of the SDG goals, for instance, and some of the other measures of whether the impact can be captured in terms of a return.
That was really helpful. I'm just looking at the questions. Stephen, are we okay to put a few more questions to our panelists?
Yes, please go ahead. We have
okay, because I know that you guys have been running these sessions without a break, so I'm sure people are ready for a short break. But we've got one question which I think we may have, I'll put it to all the panelists, and I think we've sort of covered it, but this was the most popular question that was put on the chat. So the question was, how do we make sense of resilience when markets supposedly focus on efficiency? can someone say something about the relationship between these two terms? Now, I think we have kind of looked at this from different angles, but does anybody want to, because that's the most popular question a lot of people would like the answer to. Do I need to repeat it? Did you get that?
Jump in with some thoughts on a kind of non-technical level, but I think resilience, if done properly, is efficient as well. That's one thing to bear in mind. I mean, it's about preparing, because humans do not think ahead and do not think about preparing. I mean, there are some things that necessarily you can't necessarily prepare for. I mean, I think it would have been that there were better preparations we could have done for the current pandemic, but preparing for something on this scale would most likely not have been financially viable or known, but there were definitely more preparation in the region where you, or flooding where you have so many, you can predict how often these events will be apart. I think there is, so I don't think they're necessarily opposing things, because the preparation is a really key element. But clearly there are, I mean, I'm of the opinion that markets
we're not getting you very clearly, James. Sorry,
move on to someone else then. I think
we lost you for a bit. Okay. Did anybody else want to chip in on that question?
Yeah, I'll chip in on that. Hi, James. When you recover, you can jump back in. Resilience. Okay, since Wayne's here and we're talking about wider ESG, ESG is not just about being green. That's environment, social governance. So resilience in that perspective, ESG also covers, for example, management of your supply chain, how good your managers are, how much corruption, all of that, all of the above. So when you talk about resilience, as a regular investment manager, as I've been for many, many years, I would always seek to say that my numbers and the way I do my investment process already encompasses resilience. That's what I would say, but I'm no longer in that field. But that's, I'm sure your clients would say to Wayne, right? By using the ESG stuff. So I said resilience in terms of you're not going to get into trouble with the fines and the law, etc., because you have managers who are straight and they're doing the right thing by their clients. So there's lots of ways to think about resilience. If you're talking about resilience, a straight up sort of green way, so environmental way, that's more difficult. There's less investors which focus exclusively on that. And there's lots of different ways you think about resilience too. A word that has now replaced sustainability and resilience is regenerative. So in this world, people more talk about regenerative. The difference between resilience, sustainability into regenerative is the first two kind of talks about keeping things as status quo, all right, or building up the resilience and sustainability. Regenerative is what the green markets, if you want, that's the word we move into, that we're in now, which is bringing back from the situation now to better. So if you think about the mangrove type of projects, there was desert here before, it wasn't a great situation. You bring back mangroves, you bring back an ecology which wasn't there before. That is regenerative.
Excellent. I'm very mindful of time. I just want to give any of the panelists a moment if there's anything else any of you wanted to sort of really add, because I think we won't get to all the questions, and I'm getting away from Stephen to say, yeah, we we've run over time. So any of you, James, Tammy or Wayne, have anything else you would like to add? I was always going to say that I'm sure none of you would mind if we do have a lot of questions, if people wanted to contact you, if they do have questions directly, hopefully that's fine, because there are lots of amazing questions coming out and lots of people interested in this space. No one wants to speak? Okay, well, just for me to say thank you to you all then. A really fascinating discussion, and there's a lot. This is an actual live issue in the sense that this is something that people are talking about at the moment and trying to think of how to address this issue around language sustainability. Oh, Tammy.
Hi, sorry, before we cut off, I know that this is the Harvard Students Environmental Club. What about this a thought? Harvard has one of the largest endowments in the world, university endowments, right? I'm hesitant to say it's larger than some countries. What about talking to your endowment, your foundation, about having a large allocation? Hold on, let me take that back. Let's go for bigger. The entire endowment to be ESG, right? To think about, to have an ESG component in the whole endowment, and then have a large carve out to do direct investment into regenerative projects. That's what I want to see.
If I may just shamelessly plug our next session, that's going to be on the fossil fuel divestment movement, and we're going to have someone from Harvard speak about the student movement to divest from fossil fuels, which I think if you want to hang around, or if anybody else wants to raise this question in the next session, that'd be amazing to combine these, to connect these two sessions. But just a quick reminder, that session is going to be after an hour break. But so do please come back, because that's a great question for the next session. Thank you.
Thank you. And thank you, Oliver, for that. And Tammy, I think that it sounds like you definitely need to be dialing up to that final session. So just from me, to say thank you to all the panelists, to James, to Tammy, and to Wayne for taking a time at the weekend and sharing your expertise. And it's been a real pleasure to be part of this. So great work, Oliver and Stephen. So just from me, thank you to everybody. Have a great rest of conference and weekend. And yeah, stay safe, everyone. Take care. All the best.
Thank you.
Fine. Thanks, Sangeeta. Thanks, Stephen.
And for everyone who wants to just stay online with the Zoom open, you can totally do that. We're gonna leave the call open for this hour, so you don't have to sign out and sign back in. That makes it a little easier to just join again for the in an hour. Do feel free to turn off your video and so on. If you want, you can have the chat room open and have some conversations going on there, but basically we won't have anything happening over voice or video in this time. So hopefully see you again in just an hour. Thank you very much, Sangeeta, and all of the panelists for this wonderful and really interesting conversation.